This is the story of how the world's fourth largest automaker went from record profits to the biggest loss in its history in just 2 years. Stellantis, the parent company of Jeep, Ram, Dodge, Chrysler, and 10 other brands, reported a roughly $26 billion net loss for 2025. No automaker that wasn't actively filing for bankruptcy has ever lost that much money in a single year. And what makes it worse is that just 24 months earlier, this same company posted $21.9 billion in profit. So let's walk through what happened, how the collapse unfolded, and what it means for the brands that millions of Americans have trusted for generations. Stellantis came into existence on January 16th, 2021, born from a 50-50 merger between Fiat Chrysler Automobiles and France's group PSA. The Chrysler side brought Jeep, Ram, Dodge, and Chrysler itself, while PSA contributed Peugeot, Citroën, and Opel. 14 automotive brands landed under one roof, headquartered in Amsterdam, chaired by John Elkann of Italy's Agnelli family, and run by a Portuguese executive named Carlos Tavares. Tavares had earned his reputation the hard way, turning around PSA after 2014, when that company teetered on the edge of extinction. And for 3 years at Stellantis, everything he touched seemed to work. Over $8 billion in merger synergies materialized, which doubled the original target. Revenue climbed to a record $223.16 billion in 2023, and net profit reached $21.88 billion on an operating margin of 12.8%. The best in class among mass-market automakers anywhere on Earth. By March of 2024, shares peaked at around $31 in Milan, putting the company's value at roughly $80 billion. That peak turned out to be the top of the cliff. The American business had always powered the profits, and Jeep and Ram carried most of that weight. But by mid-2024, dealers across the country were sitting on lots full of overpriced inventory that nobody wanted to buy. Models were aging out, sticker prices stayed stubbornly high, and the only answer Tavares kept offering was to cut more costs. On June 13, 2024, standing in front of an audience in Auburn Hills, Tavares offered a confession that would come to define his tenure. His exact words were, "We were arrogant, no excuse. When I am saying we were arrogant, I'm talking about myself, nobody else. I should have acted immediately." That admission came from the CEO of a company about to lose $26 billion the following year, and none of it stopped the bleeding. Less than 2 months later, on August 9th, Stellantis announced 2,450 indefinite layoffs at the Warren Truck plant, ending Ram 1,500 Classic production. UAW President Shawn Fain responded by calling Tavares a disgrace and an embarrassment to a once great American company, and pointed out that Tavares had boosted his own pay 56% while cutting thousands of jobs. For reference, Tavares collected $43 million in 2023 compensation, the highest payout for any European auto CEO, and that's when the dealer revolt started. On September 10, 2024, National Dealer Council Chairman Kevin Farish published an open letter that landed like a grenade. Farish wrote that the reckless short-term decision-making to secure record profits in 2023 has had devastating yet entirely predictable consequences, and he described the rapid degradation of our iconic American brands, Jeep, Dodge, Ram, and Chrysler. Everything accelerated from there. On September 30th, Stellantis slashed its profit guidance and warned that cash flow would swing to -$5 to $11 billion, and shares cratered 12 to 15% in a single session. October 10th brought a full leadership purge, with the CFO, the Europe chief, and the North America chief all replaced on the same day. Then, on a Sunday, December 1st, 2024, Carlos Tavares resigned. Board director Henry de Castries offered a carefully worded explanation. In recent weeks, different views have emerged which have resulted in the board and the CEO coming to today's decision. Bernstein analyst Daniel Roeska cut through the corporate language when he told clients, "We struggle to identify any scenario under which these events can be positively spun." The financial wreckage tells the story in hard numbers. Revenue dropped from $223.2 billion in 2023 to $184.8 billion in 2024, a 17% decline, and then slipped again to $180 billion in 2025. Profit followed a steeper trajectory, falling from $21 billion to around $6 billion, a 70% collapse, before landing at that $26 billion loss. Over 2 years, the swing totaled $48 billion. Most of the 2025 loss traces back to roughly $30 billion in unusual charges, including a $26 billion strategic reset booked in the second half of the year. What Stellantis did, in plain terms, was look at the entire electric vehicle strategy that Tavares built and write it off. $17.2 billion covered canceled products and impaired EV platforms alone. On the stock side, the damage kept compounding. Shares dropped 43% in 2024, lost another 15% in 2025, and as of mid-April 2026, they trade around $7 to $9. $80 billion in market value has shrunk to roughly $25 billion. The dividend has been suspended entirely for 2026, and the $3.5 share buyback program sits frozen. Cash flow is the number that separates a crisis from a death spiral, and the trend line runs in the wrong direction. Stellantis generated positive $15 billion in free cash flow in 2023, then burned negative $6 billion in 2024, then burned another negative $5.2 billion in 2025. 3 consecutive years of negative free cash flow marks the longest such streak for any major Western automaker since the 2009 financial crisis. Not every brand took the same damage, and looking at them one by one shows where the pain concentrates. Chrysler now sells exactly one volume model, the Pacifica minivan. The 300 sedan died at the end of 2023, and by August of 2024, a group of major dealers reportedly proposed buying back the Chrysler, Dodge, and Mopar trademarks outright. When your own dealers try to buy you out, confidence has hit rock bottom. Dodge looks even worse. The Charger Daytona EV was supposed to carry the brand into the electric era, but only 7,421 units sold across all of 2025, collapsing to just 346 units in the fourth quarter. Dealers were slashing $25,000 or more off R&T trim prices, and that trim has now been canceled for 2026. Total Dodge brand volume dropped 28% in 2025 to 101,927 units. The Hornet crossover, meant to attract younger buyers, managed only 9,365 sales, a 54% decline, and Stellantis pulled it from the 2026 North American lineup after at least 6 recalls on the 2024 model year. Maserati sits in even deeper trouble. Global sales crashed from over 26,000 units in 2023 to 11,300 in 2024, then to just 7,900 in 2025, the worst volume since 2012. The operating loss margin in 2024 ran around negative 25%. Stellantis brought in McKinsey in April 2025 to explore selling the brand, and Reuters reported that bidders from the UAE and China were circling. On January 1, 2026, Maserati disappeared as a separate reporting segment, which is usually a signal that a brand is being packaged for divestiture. Although CEO Filosa publicly insists Maserati is not for sale, Fiat tells its own grim story in Italy. The Mirafiori plant in Turin, the historic birthplace of the brand, produced under 20,000 cars in 2024, the lowest output since 1958. Prime Minister Giorgia Meloni publicly confronted the company over missed production commitments, turning what had been an internal manufacturing problem into a national political fight. Quality problems and dealer friction poured gasoline on everything else. 64 recalls in 2024 gave Stellantis North America the worst record of any automaker that year. Consumer Reports placed Jeep dead last among 24 brands for reliability in its 2026 report card, marking the third consecutive year at the bottom of the rankings, with Ram at 25th and Chrysler at 22nd. Bloomberg reported in February 2026 that Stellantis faces what it called a $17 billion problem on warranties, spanning PureTech petrol engines, Blue HDI diesels, and Jeep 4xe batteries. Legal fights with dealers added another layer of chaos. Stellantis sued Randy Marion CDJR in North Carolina to avoid repurchasing 3,841 unsold fleet vehicles worth roughly $180 million. And multiple securities class action lawsuits landed in April 2026 from firms including Robbins Geller and Rosen Law. All of this raises the question everyone keeps asking: is Stellantis actually going bankrupt? The honest answer is almost certainly not, at least not within the next 12 to 24 months. Here's why that's the case. Despite those enormous losses, Stellantis ended 2025 holding roughly $54 billion in industrial liquidity, enough to fund about 2.5 years of operations at the current burn rate. In March 2026, the company placed a $5.8 billion bond sale with coupons running as high as 8.25%, expensive by any measure but fully subscribed. Investors are still lending to Stellantis, even at a premium. Comparing today's situation to the 2009 Chrysler bankruptcy reveals more differences than similarities. Old Chrysler filed Chapter 11 on April 30, 2009, carrying $39.3 billion in assets during a 30% collapse in U.S. industry sales, and needed an $8 billion government rescue to emerge. Stellantis holds far more liquidity, remains investment grade, and generates strong profits in South America, where it controls roughly 29% of the Brazilian market, and in the Middle East and Africa. Credit agencies have pushed Stellantis to the edge, though. S&P downgraded the company to BBB- with a negative outlook, and Moody's sits at Baa3 with a stable outlook. One more downgrade from either agency means junk status, which would raise borrowing costs across the board. What keeps analysts uneasy isn't the balance sheet today, it's the trajectory. U.S. market share has fallen from 12.6% in 2019 to 8% in 2025, dropping Stellantis from number 4 to number 6, behind both Hyundai, Kia, and Honda. Trump's 25% auto tariffs on Mexico and Canada hit Stellantis harder than any rival, idling the Windsor assembly plant for 2 weeks and the Toluca plant for a full month, with 900 U.S. workers and 4,500 Canadian workers temporarily laid off. The net tariff cost runs about $1.7 to $1.8 billion per year. If the U.S. economy weakens or consumer demand breaks, Stellantis would face genuine liquidity stress before any other major automaker. But there are signs the bleeding has stopped, and some of them arrived faster than expected. Antonio Filosa, a 25-year Stellantis veteran born in Italy, took the CEO job on June 23, 2025 after a unanimous board vote on May 28. His approach runs in the opposite direction from Tavares. Instead of betting everything on EVs and slashing costs, Filosa has adopted what he calls freedom of choice, offering customers combustion engines, hybrids, and EVs side by side, and letting the market decide. Volume numbers started responding right away. First quarter 2026 shipments hit 1.4 million units, up 12% year-over-year, with North America climbing 17%. Jeep Wrangler sales rose 11% to 167,322 units in 2025, while the Gladiator jumped 35%. October 2025 brought the headline investment, $13 billion committed to the U.S. over 4 years, the largest in the company's 100-year American history, covering 5 new vehicle launches, 5,000 new jobs, and the reopening of the Belvidere, Illinois assembly plant in 2027. Leapmotor, the Chinese EV company that Stellantis bought a 21% stake in for $1.7 billion, delivered nearly 25,000 vehicles across Europe in the first quarter of 2026 alone, a jump of over 700% year-over-year. Those Chinese-designed EVs are now being assembled at Stellantis' Zaragoza plant in Spain, and they're helping Stellantis meet European emissions rules without paying into Tesla's compliance pool. Regulatory shifts have tilted in Stellantis' favor as well. Trump's CAFE rollback, proposed in December 2025, lowered fuel economy targets and eliminated CAFE fines. The $7,500 EV tax credit expired on September 30, 2025. Both changes reward ICE-heavy lineups like Ram and Jeep, and Filosa told reporters in January 2026 that CAFE regulation and the greenhouse gas regulation will give us more than a financial offset, but potential growth into the segment we're going to play. So here's where all of this lands. Stellantis is not dying, but the company that existed on January 1st, 2024, with 14 brands, 100% EV Europe pledge, a CEO collecting $42 million, and a $27 share price, that company is already gone and not coming back. What replaces it is still taking shape. Filosa has a major investor day scheduled for May 21, 2026 in Auburn Hills, where the full turnaround plan is expected to go public. He has said openly that he is assessing the long-term viability of all 14 brands. The Hemi comeback, the $13 billion US commitment, the Leapmotor partnership, and the Maserati portfolio review all point toward a leaner, more regionally focused automaker. The real question is not whether Stellantis survives, because it almost certainly does in some form. What matters is which of these iconic American brands make it to the other side, and what they look like when they get there. If you grew up on Jeep, Ram, or Dodge muscle cars, this is the most important story in the American auto industry right now, and we will keep following it. I'd like to hear which Stellantis brand you think has the best shot at a real comeback. Thanks for watching.